In terms of the second company, that is Relaxo Footwears. So it is focusing on low cost footwears that is catering to the 80% of India. So the all those people who are here in the uh, panelist or those who are the participants do not contribute to the 80%, rather the rest of the remaining. So it has 60,000 touch points, that is retailers as well as the distributors. It has 8 manufacturing capacities with a production capacity of 10 lakh pairs per day. So remember, the Bata has production capacity of around 4 lakh pairs a day. Paragon has 4 lakh pairs a day. The competitor, that is Campus Active Footwear, it has almost 90,000 pairs a day. So in terms of production capacity, Relaxo is the highest. If you look at financial year, from financial year 20 to 22, so the number of pairs sold in financial year 20 were 17.9 crore pairs. In financial year 22, it is 17.5. So this year their performance has decreased. Even though the revenues has increased, their profit margins have been decreased to 8.5%. That is profit after tax or net profit margin, whatever you say. In this year, they added another 2.5 lakh, which constitutes of the 10 lakh pairs per day manufacturing capacity. And they made a 140 crore capex this year. So over the years, if you can see that from financial year 20 to 22, they have average realization per pair. They have increased. So people are showing brand loyalty, and they are able to convert the same person, or they are able to take more by delivering the same from the same customer. So in terms of modes or in terms of competitive advantages, it has 82 trademarks, 10 copyrights, and 689 designs. So even if you do not understand where the Relaxo footwear stands, if you have mobile right now, what I can ask you is, you open Amazon or Flipkart or any other app that you use, you type Hawaii Chappal, and you will find the the lowest prices of Relaxo footwears. So you will find it there. The second is the people, that is Bata or Crocs or any other peers which are there, would not be competing at such a low cost, because first, that Relaxo has its economies of scale, because producing 10 lakh pairs or chappals during the per day gives you a definite advantage. The second is, Bata is into premium segments. The Crocs won't be entering into this market because it is even premium than Bata. So the normal Crocs price that you look at in the market starts from somewhere around 1900. The normal clogs or the sandals that Relaxo Footwears gives, their price starts at around 374 rupees. So there is a vast difference. So I don't think any companies such which are giving into premium segment will be entering or competing with Relaxo. Plus, the growth factors which we see is the rising demand for closed footwears, and there is uncertainty that why its market or its revenue reduced in the particular year was because the price escalation that it had. So in margin impacts over the last year, it was not able to compound its earning per share, but rather it reduced it to 8.5%. The reason being, the raw material prices increased by 25% due to war and other supply chain issues. So if you look at ethylene vinyl acetate, that composes of 62% of the raw material consumption, its price increased by 25%. there was a change in GST that was from 5% to 12%. So there was an increase in 7% without doing anything, a price in 7%. There were two COVID lockdowns and it impacted that. So over medium term, that is within 2 to 3 years, what I say is that there are risks that the exchange rate risk, as the value of the currency is going down, the cost, the dollars is increasing, and the material price might impact if the things don't settle down. If we have the same supply chain issues, or if we have the war going on, things might not settle and we might see prices of the raw material going down, and the margins either still may be impacted or they might be able to push it over to the customers. So what is the situation now? So the cost of the material consumed double from the previous year. Most of the cash flows that are used to maintain or the purchase were used to purchase or maintain the inventories. There is negative free cash flow in the current year or the previous year. Reason being the installment of a new plant worth 140 crores, which I mentioned in the previous slide. Now they have started exporting, and they are exporting around 100 crores revenues, which is contributing to 4% of the revenue. So it has certain advantages, wherein the closed footwears which are being sold more, such as shoes and sandals like Crocs, the price range that I mentioned earlier starts at 374, where the sandals constitute of 40%, shoes constitute of 60% of the total volumes that they generate. And they have tied up with major e-commerce stores where 11% revenue comes from e-commerce, with average revenue realization of more than 500. So if you look at major financials, so majority of its revenue come from north, that is 50%, the rest from east and west, and 14% from south. So they are expanding the distribution network to west and south, and even opening more exclusive black brand outlets. Over the last year, that is from financial year 20, that is this data showcases the financial year 22. So revenues grew from 12 point to 12.5%. The gross profit increased by 6.6%, but the PAT and EPS decreased by 20%. The reason being that the raw material prices as well as the GST impact that it had. If you look at the return on the capital, that the total capital that is given out by the company, it is 19.6%, higher than most of its peer. Though, as I mentioned, the free cash flow is down by 120%. Reason being that it invested 140 crore rupees into capex and increased its total capacity to 10 lakh pairs per day. Over the 3-year period, it compounded at 5%. But if you look at the free cash flow over the last 3 years, so in this year, I have calculated the data from financial year 21 and the remaining years. So if you look at till financial year 21, you can see that it has compounded almost on a decadal basis of 243. So free cash flow compounding at 243%, or ROC compounding at ROC being an average of 25%. So if I give you a simple explanation, if my cost of capital is 11%, if my ROC is 25%, so the difference, if I keep around 30% aside, that is being distributed in dividends, the rest can be reinvested, as it has shown that it has done capex. The rest, which is reinvested, can give you better returns, which showcases that the revenue growth has over the 9 years period has been 11.9% CAGR returns. But if you look at the share price returns, it is over the years of 9 years, it is 53%. So if you compare it with Nifty, it is Nifty is around 14 or max 14% on a CAGR basis. And if you look at Relaxo, it is 53%. The same goes with Bajaj Finance. If you look at Bajaj Finance, it is 52 or 53%. Uh, so that's it.